Welcome to Lecture 1 on leases. Let's begin by looking at a simple capital lease. Manufacturer Southern leased high-tech electronic equipment from Edison Leasing on January 1st, 2013. Edison purchased the equipment from International Machines at a cost of $112,080. Related information: we had a lease term of 2 years or 8 quarterly payments, quarterly rental payments of $15,000 at the beginning of each period, an economic life of the asset of 2 years, fair value of the asset of $112,080, an implicit interest rate of 8%, also the leasee's incremental borrowing rate. Now, a couple of things. The implicit rate is the rate of return for the lessor. The incremental borrowing rate is the amount the leasee would borrow if they were to finance the lease or finance a purchase of the asset. So those two are important. Keep in mind the lessor always uses the implicit rate of interest for all calculations. The leasee, however, will use the incremental borrowing rate unless both rates are known. If the leasee knows both the incremental and the implicit rates, they must use the lower rate. Now, in this problem, it's not an issue because they're both 8%. So it doesn't matter if the leasee knows it or not. We know it, so therefore we would always use 8% since they are equal. But keep in mind, from the leasee standpoint, if both rates are known, they use the lower of the two. Prepare a lease amortization schedule and appropriate entries for Manufacturer Southern from the inception of the lease through January 1st, 2014. Depreciation is recorded at the end of each fiscal year on a straight line basis. Alright, so first, Manufacturer Southern is actually the leasee. So we've got to remember, for all the entries we are doing here, we are actually doing them from the leasee standpoint. Alright, so what's step one? First, we need to determine the present value of the minimum lease payments. This is the only way to determine the carry value of the lease payable. In other words, what are we going to carry this asset at? The leasee always carries the leased asset at the present value of the minimum lease payments. So to find that, the first thing we have to do is take the $15,000 lease payments and multiply that by the present value factor. So remember, these $15,000 payments are annual, or not annual, but quarterly payments for some period of time in the future. In this case, 2 years or 8 payments. What we have to do is figure out, okay, what is the value of those incremental payments in today's dollars? So we need to find the present value. Now, for our class and many, we use the PV tables for intermediate accounting, so we're actually going to look at the present value tables. Now, when we do that, we have to understand that this is an annuity. Since the payments are due at the beginning of each period, it is considered an annuity due. That's important because annuities can be one of two things. It can be an ordinary annuity, which means the payment is at the end of each period, or an annuity due, which means that the payments are due at the beginning. So this is an annuity due. So from this point, we will use the PV and annuity due table. Now, the next thing to use the PV, we need to know the number of periods and the interest rate per period. Well, when we look, we see that this is a 2-year or quarterly payment. So there's going to be 8 payments in total. So for present value, N equals 8. Then we have to find the I. Well, the interest rate is 8% per year, but remember, there's 4 payments per year because it's paid quarterly. So you're going to take that 8% and divide it by 4. So each period would have a rate of 2% for that period. Okay? So when we do that, we find that N equals 8, I equals 2. So now we need to look up the PV, and we're going to do 15,000. And when you look at the PV tables for an annuity due of $1, you'll do that, you'll get 7.47199. Alright, so you're going to take that 15,000 times the present value of 7.47199, and at this point I assume you understand the concept of present value. So we're just going to go ahead and multiply that out, and when you do that, you get right at $112,080. And the reason being, when the rates are exactly the same, and there's absolutely no residual value, and specifically an unguaranteed residual, but at any rate, when the rates are the same and there's no residual value to deal with, the present value of the minimum lease payment should equal the fair value, and that's the case here. So we know that the carry value of this asset is $112,080. Now, is this a capital lease? It is, because remember, a capital lease needs to meet one of 4 rules. So let's go talk about those for just a second. One, does ownership transfer? And the answer to that is absolutely not. Nowhere in this does it state that manufacturers will own that equipment at the end of the lease term. Two, is there a bargain purchase option? Again, the answer would be no, because nowhere in our contract detail do we see anything about being able to do a bargain purchase where we can pay a small fee and end up owning the asset at the end as manufacturers. So neither of those are true. The next rule is the 75% rule. And what the 75% rule states is the lease term 75% or more of the asset's life? So let's check. The lease term is 2 years. The asset's life is 2 years. So yes, absolutely, it is 100% of the asset's life. That's one qualification, so that's an yes. So that automatically makes it a capital lease. And then the fourth possibility is it 90% or more of the present, or excuse me, is the present value of the lease payments 90% or more of fair value? And the answer to that is also yes, because the PV of the lease payments is $112,080, which is 100% of the fair value. So of those four criteria, we only need to meet one, and we've actually met two of the criteria. So therefore, this is a capital lease, and we must treat it as such. All right, so one, prepare a lease amortization. Well, when we do a lease amortization, we treat it very much like a financed asset. We've got this lease payable of $112,000 we're going to put on our books, and we are going to pay that down to zero over time, very much like an installment note. Okay, so our starting point is going to be the inception of our lease, which is not December 31st, but January 1st, 2013 in this problem. And where we start is our beginning balance of $112,080. Now, as we amortize this, we have to look at when our payments is, and our payments are at the beginning of each period. So that means on January 1st, 2013, we're going to make our first $15,000 payment. Well, since no time has passed, interest accrues over time, and since there has been no time, there would be no interest. So that first payment is 100% going to pay down the actual principal balance of the lease payable there. So that 112 is going to become 97. Now, when's our next payment? Well, these are quarterly payments, so the next payment is going to be on April 1st of 2013. And again, that payment is going to be for $15,000. Now, how much of that's going to be interest? Well, to figure interest, you're going to take the carry value. So you're going to take the 97,080 and you're going to multiply it by the 2% because that's a quarterly interest rate. 8% per year means 2% per quarter. So when you take 97,080 times 2%, you get 1,942. Now, change in balance would again be the difference between 15 and 1942 there, and that leaves us 13,058, and that brings our balance to 84,022. And again, we're going to do the same thing for each of our lease payments. Now, I'm not going to talk about all these calculations, but July 1st, we do $15,000. When you multiply it out, you get $1,680 for your actual interest. That brings our reduction in balance to $13,320, which brings us to $70,702. Our next payment would be October 1st of 2013, be $15,000. Interest should be $1,414, again $70,702 times 2%. Reduction of balance would be $13,586, bringing us to $57,116. Now let's do one more just for the fun of it, and that would be January 1st, 2014. Again, you see a very clear repetition to all of these entries. And as we go through more lectures, we'll do a full amortization, but we're going to stop at this because it's getting a little monotonous here. But once you're done, this should be how your amortization chart looks. Now, based on this information, we can then do our journal entries. So let's look at how Manufacturer and Southern would record this. And again, keep in mind, Manufacturer and Southern is the leasee. So that makes a big difference when we're doing these entries, okay? So let me split my screen a little bit lower so that we can see that amortization chart while we do the journal entry. So give me just a second here. Perfect. All right. Now let's go through the entries that Manufacturing Southern would actually record as the leasee. So January 1st, 2013, we actually need to record this lease. We treat a leased asset very much like a purchase asset. So when we put it on our books, we have to carry it as an actual asset. So we're going to put it on as leased equipment. And we're going to carry that leased equipment at the present value of the minimum lease payments, which we found to be $112,080. That's an asset to us. We include that as an asset. Now the next thing we got to put on our books is very much like we finance the asset. when we do a capital lease, it's very much like we are financing the asset. So we're going to record the lease payable on there at the exact same amount, the $112,080. So that's the initial entry to create the lease on our books. We put that equipment on and we record the lease payable. Now, also on January 1st, 2013, we have to do our first lease payment. We'll go right back here. We make that payment of $15,000, which represents cash. None of it goes to interest because no time has passed. So that means all of it is going to reduce our payable. So really all we need to do is reduce our lease payable. So we're going to debit our lease payable for the $15,000 and we're going to credit our cash for $15,000. So now we've recorded the very first payment on our capital lease. Okay, so let's continue on. That would be all we would need to do at the inception of the lease from the leasee standpoint. So that brings us to our first interest payment, which would occur on April 1st of 2013. Now when we do that, again, we're going to follow our amortization. If you can create an amortization chart, you should be able to do this. One, the payment represents the cash we're paying out. The interest recorded, from a leasee standpoint, the interest recorded is actually an expense. So that would represent the interest expense. And then the change in balance simply gives us the change or the reduction in the lease payable. So by that definition, one, since this is an expense are debits accounts, so we need to debit the account. The change in balance is a reduction in the lease payable, so to reduce liabilities, we actually need to debit those as well. So the entry would go interest expense, and we're going to pull that straight 1942 off of our amortization chart. Then we're going to show our lease payable. Our lease payable is going to be the 13058, the actual reduction, and that leaves us with the cash payment, which we know to be $15,000. So that would be our entry on April 1st. Now, July 1st would be the exact same concept. We would go in and we'd do interest expense, and our interest expense would go in at $1680. Our lease payable would again be hit for $13,320, just like what we did in our amortization chart, and that brings us to our cash of $15,000. Now continuing on, we would know to go in and we'd do our next entry, which would be October 1st of 13. And again, it's the exact same entry. We're going to do the interest expense, and again we're going to pull the October numbers there, which is 1414. We're going to do the lease payable. The lease payable is going in at $13,586, and that brings us to the cash payment of $15,000. Now here's where we get a little bit different, and that's going to be December 31st. Our next lease payment's actually not due until January 1st, but the problem is in accounting we've got the accrual-based accounting, which means as interest accrues we need to journalize it before we produce financial statements. So at the end of the period we actually need to record the interest that has accrued even though we're not actually making a payment. So how would we do that? Well, one, we need to record the interest expense, and since we're not paying it at this point, it would be interest payable. Well, how much? Well, on January 1st, we have accrued of $1142. As of the close of business on December 31st, that all has been accrued. Since it's only one day later that we're actually making the payment, we'd need to record all interest that had accrued as of December 31st. So it would be the full amount, and instead of doing cash here, we're going to do $1142 in interest payable. Now notice we wouldn't do anything to the lease payable because the lease payable does not actually get decreased until you physically make a payment. Now what else do we have to do? Well, since this is an asset that we've recorded on our books, the leasing must always record depreciation. We're going to have to actually depreciate this asset over its life. So we're going to debit depreciation expense and we're going to credit the accumulated depreciation. Now how are we going to do this? Well, this company uses straight line method, which simply indicates that we take the actual cost of the asset minus the salvage or residual value and divide it by useful life. Now in the terms of a lease, from the leasing standpoint, the useful life is actually the lease terms. So in this case it would be 2 years. Economic life doesn't necessarily matter unless there's a BPO involved. So in this case, since there's no BPO, we're actually going to depreciate this just over the lease life, so 2 years. So we're going to take the 112,080 minus 0 because there's absolutely no residual value mentioned in this problem. So it's going to be 112,080 divided by 2 years, which is the lease term. And when you do that, you get 56,040. So keep in mind we do have to depreciate the leased asset over the life of the lease. Now, there are some times when we have to include residual value, and that'll come in later lectures when we talk about unguaranteed versus guaranteed residual. But at any rate, we must depreciate the asset. So that brings us to January 1st, 2014, when we physically make that payment. Now, keep in mind we've already accrued the interest expense as of last night, so we just need to go in and hit interest payable for the 1142. Then we need to reduce the lease payable by the amount that's shown there, 13,858, and then the last thing would be the cash payment of 15,000. So this is a very simple capital lease. Talk a little bit about how we calculate the PV, and this is just from the leasee side. Now when we get into lecture 2, we're going to do this exact same problem, but we're going to look at it from Edison's side, which is the leaseor. Okay? I hope this has helped clarify any questions on this type of problem.